Good afternoon, everyone. Welcome to our webcast on short verticals. I'm Connie Hill. I'm happy to see each and every one of you here today. Many of you are repeats that come week after week, and we so appreciate your participation. There may be some of you that are newer to this webcast. If you are, feel free to say hello. Let us know that. We'll make sure we treat you right in here today. How many of you have had the situation, and I think it could be many of you, that you get into a short vertical trade and it does not work the way you wanted it to, and you're trying to figure out how to fix it. You're trying to figure out how to get out. Well, in a survey that we had in Monday's class that I taught for Barb, we talked about short verticals. And that was something that I said, if you guys are having troubles with something, feel free to tell me what it is so we can address it. And that's going to be a point of our discussion here today, is what do you do when a trade goes against you? All right, so that could relate to almost everybody here. I hope you're following me on X. I'm Connie Hill, CS, and I'll post educational content throughout the week. We have the pleasure of having Cameron May in the chat to help out. I'm so glad Cameron's here to help answer maybe some questions I can't quite get to, or maybe it's something that might be a little bit off topic. So glad that Cameron is here. He posts on X as well. He is Cameron May CS. So it's free, it's easy, follow us. And I will also say it's one way you can communicate with us that we can do. We can't necessarily do emails with you or something like that, but we can communicate over X. So I think that's a nice bonus for you. Let's go through our disclosures and lay out the agenda for today. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for informational and educational purposes only. Don't consider it a recommendation. We'll be using the Paper Money software application. It's for educational purposes only. I think it's a fantastic tool as you're trying strategies and maybe trying out new rules. Do it on a paper trade account where you're using market data, but not your own money. Investing involves risk, including the loss of principal. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And that's an important thing for our class because that's what we're doing all the time. We're selling options. If it's in the money, it has a higher risk of being assigned early. One thing Paper Money does not do and replicate well is early assignments. Okay, it doesn't happen to you in paper, but it can and will happen to you in a live account. Past performance of any security or strategy does not guarantee future results or success. All right. Typically, I want to take one aspect of short verticals and talk about it. This is an intermediate level class, so you're coming in with the idea that maybe you know a little bit about short verticals. I don't think you have to feel like you're the best expert at trading them, right? But you have some familiarity with them. If you're not familiar with them, go hit Cameron May's class. He teaches getting started with options. And he'll go through a series where he will touch on every single of the major option trades that are building blocks to get going with. And he'll touch on short verticals. He'll do a whole class on it. So if you feel a little overwhelmed after our discussion today because that's the case, go ahead and hit Cameron's class. He does a great job with it. We always want to do some example trades and talk about trade management, which is kind of going back to the thing I said earlier about have any of you ever been stuck in a short vertical that was going against you and you just were trying to fix it and you didn't know how to possibly fix it. If you want, go ahead, respond to me here, respond to your computer, your dog, your cat, whoever. Say, yeah, that sounds like me, or no, I'm so new, I haven't run into that. All right. The aspect I wanted to touch on a little bit here today, last time, I should say, we touched on the characteristics of the stocks that we wanted, and we redid our watch list. And it's a watch list that we're just going to use in our class, and we'll update it about once a month. Today, just wanted to go through a couple of things so you get more comfortable with some of the math. We're going to be doing some math today, okay? Remember, in a credit spread, when you initially put that on, whatever the max credit is that you bring into your account, that's what you're planning on using or having as your maximum gain. Should not get any better than that unless you do some other things separately outside of the trade, okay, like busting the trade up. The max loss, remember, is going to be the difference between your two strike prices. Sometimes it's 10 or 5 or 250 or 2, okay? Minus whatever the credit is, that's going to be your maximum theoretical max loss at options expiration. And then on the break-even point, your short put strike minus the credit you received is your break-even. Now, in this kind of a trade, one thing that's nice about this particular one is that you don't have to be perfect in order to be profitable in this kind of a trade. You know, we expect, if we're doing a bullish one, man, we expect the stock to be going up bullishly. But if it doesn't ruin everything. What if it just kind of goes flat? Oh, my little markers aren't working today. Yeah, if it just goes flat, we still might be okay. If it pulls back a little bit, but not through our short strike. Yeah, it could still possibly work out for us. And even if it does go a little below where our short strike is, there's still a possibility it could work out just fine. Okay, so it's kind of like 3 out of 4 scenarios you could potentially be profitable in this kind of a trade. What I was asking about, you know, getting in a pickle with some of your short verticals, Chris says, I've got a few of those right now with the market being down a bit. Yeah, the market was down early on. I was just looking over my charts on my other monitor to the other side, and it looks like they were trying to rally, trying to get positive. Looks like they've turned south again. It's for today. Let's hop over to Thinkorswim. And we're going to start here. And the question is, even though we've had a third day of the market pulling back, are we still in an uptrend? I would say yes, right? 3 days ago, so this was on Tuesday, the 23rd, SPX hit an all-time high again. NDX hit an all-time high. When we have days that are pulling back like this, quite honestly, some people are like happy because they're like, man, this one stock has just been running forever. Now it's finally pulling back. It's going to give us a better opportunity to get in on it. And that's actually a scenario with a couple of stocks that we're going to be looking at here today as some example trades is, oh, yeah, this little pullback has been nice to give us a fresh entry. Okay, so SPX up. NDX looks so similar. And let's get that chart up here. So yeah, put in another all-time high on Tuesday as well. A little bit of pulling back. This blue line is a 10-period moving average, so really short term. This red line is a 30-period moving average, which is more indicative of an intermediate trend. So it's well above, even coming down to that intermediate trend line, that moving average. Okay, so we're not necessarily seeing lower lows at this point, or even one lower low. So it's just a little pullback in the current uptrend right now. Now, this could influence what you might trade, right? You might feel like, maybe this is a great spot to do a short vertical because sometimes we are interested in trading something that maybe is, say, bullish to neutral, and it's pulling back right now, and you're like, oh, maybe it's pulling down to support. That might work out well for a short vertical, or put vertical. We'll just take a quick look at the VIX, and really, it still has been in a very small range. Let me just zoom in here a little bit. You can see I've had a channel that it's just kind of been kind of staying in. It's still inside the channel. It is poking up a little bit here. It's at 17.4 right now. Had been, looks like maybe close to 18 earlier in the day. So yeah, it's kind of getting into a little bit of space here where, okay, maybe we are going to see some selling off activity, but it's not sky high. But we do want to notice that, okay, it's not down at super low. All right, maybe it's down kind of at average low. Okay, so just making that distinction. Rick says, what happened to the option chain under the trade tab? I don't know what happened to the option chain under the trade tab. So delete that. Sometimes there may be stocks that don't have options, and so you won't see an option chain for them, and so there'll be nothing there. Okay. But mine is working okay. If you're having an issue and you're like, no, I know this one has an option chain on it, just check your spelling. Make sure you've got the right stock up that you're looking for. Okay. All right. I want to talk about this idea of salvaging a trade because we have been trying to do that on one particular trade in our class. And so we're going to start with it. Okay. DHI. Let me just show you the chart. We'll start with it. This is a home builder stock, and we got in right here at this green over where it was looking like it was bouncing off the 10-period moving average. We expected that thing to go up. So we sold a short put vertical on it. Well, what has it done? Well, it's done nothing but go down, down, down. That's not what we thought it was going to do. And sometimes in a situation like that, you just kind of give it some room, give it a little leeway, see if it just kind of comes back. After all, when you put it on, it was a higher probability. Typically, what we'll do in this class, it's got to be 60% or higher, which is considered higher probability. However, it just kept going down, down, even on days when the market was having a little bit of a rally. You know, it was kind of petering out. Now, some of it could have to do with maybe that one interest rate cut was already baked in, and maybe the fact that we didn't get a 0.5 basis point cut, maybe that threw things off. Who knows? Whatever. In any case, on this day, what we decided to do was to buy back the short put. And we mentioned, I think, briefly, maybe we didn't mention briefly, it could have been a different one we mentioned about. The idea here was fine. We think we're wrong on the trade. It's made a lower low. Let's buy back this short put that's bullish. We're going to take a big loss on it, and let's hope this thing drops and continues to drop to help make up that deficit, okay, and then keep that long put in place. Well, this, you can kind of see here, just kind of went sideways after that. It didn't really drop. And in fact, yesterday, it looked like maybe it was like trying to bounce here. All right, so what did we do? We said, let's go ahead and just get out. Let's just take our lumps, and I'm going to show you the numbers. And I'm going to tell you right up front, we did not end up managing to save it. And it still could be, if we were maybe a little bit more patient with it, maybe it will come back above the short strike here of 170. It's $5 away, but you know, it could. So let's look at these numbers. Now, let me ask you, has anybody tried to do that before, where you bought back the short option and said, all right, we've got a long put here. Let's let the put drop. If this thing has really changed, drop, baby, drop, and give us some decent numbers. Well, if you've done that before, you might be familiar with that. So what I'm going to do, let's come over here to the monitor tab, account statement. I've got DHI up, and I'm going to bring up just a little blank spreadsheet for us to record a couple of numbers on, okay? So when we got in on the 11th, we brought in a credit of $1.45. That was our max theoretical gain. At that point, what's our max theoretical loss? Should be $5 minus 145. So that would be what? $3.55, right? So I'm just going to put in here 145, 355. I'm just going to put an ML here and a max gain here, an MG here, okay? That was the initial. Now, because we went ahead and managed it and bought back our short put, that was done on the 22nd, and we paid a hearty price for it. Let's see. Let me make sure I'm on the right one. Yeah, the one we bought back, we had to do it at $12.15. That was a pretty decent loss. Okay, so that's on our 175. So on our 175, we brought in 430, but we turned around, had to buy it back at 12.15. So the difference here, let's just do some math. 12.15 minus 4.3, we're taking the difference between those two numbers. We had a $7.85 deficit by buying it back and kind of saying, all right, long put, you better drop, sucker. You better make up some ground here because we need to make up $7.85 somehow, okay? Well, it didn't fall. Many times it will, many times it won't. But say if it drops and you get some decent mileage out of it, I'm going to say. Some traders might consider just being done with that part of the trade then. They might go, okay, that made up enough for me. I'm good. I'm happy, especially if it looks like the stock's getting ready to rebound and head back up. Okay. So in this case, this was for, I'm just going to put in here, this was the 175 put. Okay. The numbers on the 170 put were this. We paid $285 for it, and then we were able to sell it for $670. Okay, so I'm going to take the difference between $670 and 2.85. Oops, let me get a little plus in there. Less $670. Make sure I'm using the right number. Minus $285 gives us a deficit of $385, or a difference of $385. Were we able to make up all of the $785? We didn't. We did not make it up. We only made up $385. So that actually put us at a loss. You run those numbers, we're at a loss that was even bigger than our theoretical max loss here. We'd kept the spread together, held it on to options expiration, let it expire in the money. Our theoretical max loss would have been $355. In this case, it's worse because we broke the trade apart. Now, the intent wasn't for us to lose more. The intent was for us to kind of make up that deficit, but it didn't work out. And so sometimes we'll have good success trying to change polarity is what we say. Okay, we're not bullish anymore. Now we're bearish. Sometimes it works really well, and sometimes it just doesn't. Okay, so in this case, this is one that, guess what? It did not work that well. Okay, any questions on kind of any aspect of those numbers or that scenario? Let's see here. Kevin says yes, and I just seem to end up with losses on both ends. So you've had that happen before, and that's what happened here. And that's why you have to be really convinced that the trade or the trend of the trade has changed. You've got a lower low, you've got a lower high. It's really looking that way, which we had a lower low. Okay. But it's just not looking like it's going to work out. Okay. So we're going to take a bigger loss on that one. Sometimes they work, sometimes it doesn't. We've had actually some pretty good success with them working. This is the first one that hasn't worked out to our benefit for a long period of time. So where did the 785 come from? Let's go back there to, let me grab the little worksheet, the blank worksheet. I popped some numbers in. So the 785 came from this. It came from us buying back our buying back the 430 short leg. We received a credit of 430, but when we went and bought it back, we paid $12.15 for it. And so the difference between those two numbers, that's the 785. And that's where that came from. So I just have a little math in there, 12.15 minus 4.3. So that's when we knew, okay, that's how much it needs to make up for us. And it didn't make up as much as we wanted. Okay. Chris says, I feel more comfortable closing out a trade completely. I guess there could be situations when this might be feasible. There might be some scenarios when it might be feasible and it might be appropriate. You know, maybe in the case of, bad news coming out and you're seeing a major gap down, lots of selling off, a lot of volume, things of that nature that are like, oh yeah, this thing has totally changed now. This one I would say was more borderline. I was doing it based on technical analysis, but not necessarily any bad news for the stock. So, yeah. Myron, did we answer your question as well about the last calculation? Let's make sure that that's covered here. So the 170 leg, when we got into the trade, that was our hedge leg. So we paid $285 for it. And then when we sold it, because it wasn't dropping like we expected it to, in fact, it looked like it was going to go back up, put us with a bigger loss. We bought it back for $670. So it was just the difference in those two prices, $670 and $285. That's where that came from. Coco says, can you confirm max loss equals strike 1 minus strike 2 plus or minus credit received? So max loss on these trades is the difference in the strikes. So I think that's what you're saying, strike 1 and strike 2. So yeah, the difference in the strike prices, whatever that is, in this case it was $5, minus the credit. In this case it was 145. So the max theoretical loss at options expiration was 355. Okay, so I think you've got your math down there. Okay, Coco. All right. Myron wanted 670 and 285. Where are these numbers? I think you're looking at maybe, well, the 670 is in this 385 calculation. If you look in here in the formula, I put 6.7 and then I put minus 2.85, which was what we paid for it initially. And then we just had the difference of those two numbers. Okay. You may have to go back and review that, but I did want to spend some time on it because we've talked about it and you guys have had a ton of questions. So we tried it on one, and this particular one did not work that well. Others in the past have. This one was kind of a disappointment. Okay. And that happens. All right, we are going to move on. I want to spend just a quick moment on a couple of trades that you're going to have questions on. And that is Gilead and Lowe that we put in 2 weeks ago because we're down on both of them. So the question is, we've got 20, let's see how many days left, 22 days in both of these trades. So the question is, are we sure we're wrong on this one? Are we sure we're wrong? Let's pull up Gilead here first. We're down on it, but does that mean our technical analysis is wrong? Giving you a little bit bigger picture here. So stock had been upward trending. It looked like when we got in right there that it was, maybe bouncing off some diagonal support there, kind of, and maybe a bounce off this 30-day moving average. So it looked like after a 2-day pullback, some might have even called that a hold, right? In any case, what is it doing? It's not going the way we thought it would go, right? We were expecting it to go up. Our short leg here is 115. I've got my blue line there, and it's been down below it for about 10 days. So are we wrong on the trade? Well, we do have a slightly lower low, and the day we got in turned out to be a lower high. We weren't expecting it to be a lower high. We were expecting the stock to continue to buzz on up, and it hasn't. So this is in a situation where you say, are we wrong on the trade? This gray line here is the 100-day moving average. And in the past, when it's really pulled back quite far, it has bounced at the 100-day moving average. So what we're going to do here is we're going to give it a chance to bounce. Okay. If it ends up closing down below that 100-day moving average, then we're going to have to take some defensive action, either closing the trade down altogether, or changing polarity and doing the same thing where we buy back the short put, hold on to the long put, and hope that baby drops to make up the deficit that we're going to take if we were to go and buy back the short put. Okay. Lowe's is in the same boat. Okay. So we're just going to look at its chart here real quick. It's not down as much as Gilead, but kind of similar thing here. It's just down at support. This 256 area kind of has been an old resistance, new support, just kind of hanging there. So we're going to give it the opportunity to go back up. Yep, we're down on the trade. Yep, it's below our short strike. This is a situation where paper money would not assign you early, but the real market could possibly have assigned us early on this trade. Okay, that is one of those circumstances. All right. Any other question? Let's see, on the scratch pad, let's see. How do I use the scripts in the scratch pad, meaning how do I copy it into your Thinkorswim? Quick question there from Info Nerd. Good to see you, Info Nerd. Let's show you. Yeah, I've got a 1 month, you can't even really tell that's what it is right here, but this is a 1 month percent change, a 3 month percent change column, and I do keep the calculations on here. So I will share with you, well, I'll share with you the whole description. The only piece of what you need here, that's for the 1 month. Let me copy over the 3 month. Really, you just need the URL, and even then, just part of the URL. So for example, if I had this out in and copied it over, remember, anytime we share script with you, it's not guaranteed as to accuracy or timing. So I might come in here and I'd say, okay, here's the beginning of this URL. It's right after the slash. It starts with an exclamation point. I'm going to copy it, come up to setup, open shared item. Then you just paste just the URL information in there. Okay. It should have 9 characters. This one has 9 characters. Some of the older ones have 7 characters. The new ones have 9 characters and only start with an exclamation point, although old URLs still work. You hit preview, you hit import, but I'm not going to import it because I don't want to junk my charts up. Okay. And you just go ahead and import it. Okay. So that's how you do that. All right. Let's see. Hey, Brett Crowther's going to help us for a few minutes. Awesome. You can throw any question you want at Brett too. Okay, you guys have been asking some really good questions. So R1 says, how do you achieve the maximum loss early? In the case that we looked at with DHI, the making it a max, and actually went beyond our max theoretical loss at the beginning of the trade, because we addressed the legs separately and it didn't work out for us. Okay. And so it's when you break this spread apart, you start working with the individual legs and timing with the individual legs. That's how that can happen. Okay. Hopefully, what does that script do? So the 2 scripts that I just copied, remember, they're not guaranteed as to accuracy or timing. This one, the first one where it says 1 month, is just what's the percent change on whatever's in the watch list here in the last month. And this one's in the last 3 months. Just doing a quick calculation for us. All right. Would like to look at a couple of new setups here. All right. Let's take a look at all of these are coming off our watch list that we created a couple of weeks ago. And the first one on tap is, let's put our link back in here. It's going to be IBM. What are we seeing here on IBM? Well, it's interesting because it's resumed an uptrend. It's been making higher highs and higher lows. And then today it looks like, well, actually, I'm going to draw in a flagpole for you. Looks like somebody, if you wanted to, you could take this starting at the screen candle and going up, could say that is a flagpole. It consolidated kind of flat for a couple of days, right? We have a flag here, and then what's it doing today? Boom, it's breaking out of that flag pattern. I've got the volume down here. We're seeing some decent volume on it as well. Okay, that lets us know institutions and others are typically in the trade as well, not just retailers. Okay, so we're going to use IBM. You can, if you saw a flag, you could do a swing trade on it and maybe have swing trade parameters. In this case, we're just going to recognize that it's a valid entry that some traders might use and go ahead with the spread on it. Okay, so we're going to head over to the trade tab. And after we get to the trade tab, what's the next thing we decide? The next thing we decide, tell your computer, your dog, is what strike price we want to be in. Now, ignore these other ones here. These are part of a different trade, okay? But typically 20 to 40 days worth of time is ideal. Now, right now, these October options, they're at the short end of that window, right? They've got 22 days left, but we still could find some trades that might work out for us, give us a percent return that we're happy with. All right, so as we head on over here to the strike prices, what's the next thing we do? Yeah, we typically are going to look at this delta column to help us decide what strike price we want to sell. And in this case, we've got several we could consider. Usually it's a high 20-something delta or a 30-something delta, or sometimes maybe a low 40-something delta. So we've got a 43, a 38, a 33, a 28. So we actually have some decent choices here. And some of them have better open interest than the others. We're going to actually use this 33 delta here. I'm glad that it had some volume moving in here today, 209 contracts so far. The ones with the 50-cent increments are a little bit newer, so they don't have quite as much open interest to this point. Well, we're going to go ahead and we're going to say sell vertical, bring that up. And okay, it's trading a little bit nicer than it was actually a little bit earlier. And this one, if we were to sell this, right now it's going to start out at a 64% probability of success. So is that higher probability? Yeah. So the trade we're going to construct here is with the idea that we want to bring in that credit and it has a high probability of expiring out of the money. Now, the other step we'll take here is determining what kind of a return we have here. Quite honestly, this is going to be a little bit higher than I think we need. And so some might choose to back off and do a 270, 267.50, but let's run through the math real quick. All right. Let's go $2.50, the difference between the strike prices, right? Minus the credit, which right now is at 85 cents. And I'm just going to kind of lock that in here. Will give us what our max theoretical loss is. So we're going to be risking $1.65 to make 85. Okay, with a higher probability trade. What kind of a return is that going to give us? I'm going to tell you it's going to be a little on the juicy side. Okay, so 0.85 divided by 1.65 gives us 51%. That is pretty juicy. Some people might say, ooh, well, let's back off the delta then. Let's go a little bit further out of the money, a little bit higher probability of success and still get paid pretty decent for it. Okay, so that's what we're going to do. We'll go 270, 267, 50. Like I said, the numbers changed a little bit since when I did my original math. And on my original math, it was actually about a 72-cent credit. All right, so in this case, the gain, max theoretical gain would be 72 cents. And then grab Mr. Calculator here, clear this out. So 2.5 minus 0.72, we're going to be risking $1.78 to make 72. Okay. On that one, let's see how that works out. We'll take 0.72 divided by 1.78. That's about 40%. And then in this case, that strike price is about a 68% probability of success of expiring out of the money. Okay, so you get to decide, do I want more premium or do I want a higher probability of success? And ideally, we're trying to balance that to find a happy medium, something that Goldilocks is happy with, that's just right. But it could be different for each of you, right? You might not prefer those strike prices. You might like the first ones we did. Now, we can risk in our class, we can risk $1,500 a trade. So let's divide our 1,500 by $1.78. That's going to say 842. So we're going to slide that decimal over. We can do 8 contracts. Not going to do more than 8. All right, so 8 it is. If you're in a smaller account and you can't risk that much, something with the $2.50 wide spread is really helpful because then you can kind of hopefully take, do 1 contract or 2 contracts on it. Maybe if you're risking a little bit less like we do in the trading a smaller account class. Okay, let's go and put in our exit order, our order that says, hey, if we get most of this credit of 72 cents, if we get a chunk of it, let's close it out. We're not going to try to bleed every little last penny out of it. That's what I do with my toothpaste, but it might not be best for trading credit spreads because it's really hard to actually get it all. Okay, so we'll create our opposite order. And when we get a chunk, and you decide that percent, is it 50%, 60%, 70%? What is it? You can determine that. For this one, let's go, say 70%. So if 70% we've captured, then only 30% is left. So we'll take 0.72 times that 0.3. We're going to go buy it back at 21 cents. We're going to put this order out there. We're going to let the software take care of it. We're not going to have to try to catch it. And many times on these types of trades, people don't like to put in a stop because they already have a hedged position. And if you put in a stop, the other thing, it doesn't allow you to switch polarity in the event that something goes wrong, right? In the event that something goes wrong, you might say, the trend has changed. Let's go buy back this short put, like in this case, and let the long put run. Okay, so you get to decide those individual characteristics and paper trade it and see what is comfortable to you. Okay, and I'm going to put that to our bullish short verticals bucket. Okay. Brett's helping answer that question. Thank you, Brett. Andy says, is the spread okay on these spreads? Let's talk about it. 370 by 390. So a 20-cent spread here. And just you can do just a quick calculation with it. You can take 20 cents and divide it by, typically I'll go off the ask price, 3.85. And that says, okay, it's about 5%, 5.19% is the spread. So you say, is that reasonable? Yeah, most people are going to think that's reasonable. It's doable. At say 10%, if it were 10%, some people would start to think out and go, maybe there's not quite enough activity here in this option. Maybe that bid-ask spread is too wide. And so they might kind of chop it off there and say anything over 10, I'm not going to do. Okay, so you can judge that. If it's 7, great. If it's 2, we're happy campers if it's 2. 5% is great. That 5% makes me happy. Okay, so hopefully that makes sense to you. All right, let's look at another example here while we have time. Let's do this one. This one's kind of interesting. Palo Alto Networks. Okay, it's been in a nice uptrend, you can see. What has it done recently? Well, it just ran up. It had a nice little pullback. Right, when we see nice little pullbacks, that can give us an opportunity to get in when we see a bullish signal. So some may say, okay, it's down at support at $200. Some people like getting in on an entry right at support. This one is not going to be a hold though, unless it really motors up. It's not going to close higher than the high of our low day here, which was yesterday's candle. It didn't trade above it either. Okay, and so the rule that we would look on this one is it's at support. Some people like that. If you are a person that likes to see a little bit more, wait till you get a little bit more. Maybe you're somebody that's more comfortable if you get a hold or at least a trade above the high of the low day. Okay, so it is simply up to you. Let's go to our trade tab. We've got the same thing going on here. It's got weekly, so sometimes we could use those weeklies. The 22 days here, we're going to stick with these October 17th just because they're in the kind of that prime spot of that 20 to 40 day window, some traders like. And there's typically a lot of open interest on the monthly expirations. Okay, next up, Delta. Right, that's the next step. We figure out what strike we want to sell. In this case, the 32 Delta might be nice, but I'm not liking the open interest here. Yeah, it could go up. The spread isn't that bad. It's only 15 cents. But if you're somebody who likes to do, 5 contracts, that might be a little tight. So we could choose. We're going to go with the 200 strike and the 195. Okay, so we're going to hit sell vertical. Again, this is going to actually be a pretty juicy premium. The implied volatility, as I'd say, isn't super high, but it is a little bit higher in the 30s. So it's kind of like medium high, which means expectation for movement and a little bit of that implied volatility priced into the options. All right. Let's go ahead and put a lock on this. So our max theoretical gain here is 90 cents. So 250 minus our 90 cents is a 140. So 140 is our theoretical max loss. 190 is our theoretical max gain. We already know it's going to be a pretty decent percent. Let's get that calculator up here. So if we have 0.9 divided by, actually, it's not 1.4. It's you know what? Let me do the math for real. 2.5. I was thinking it was a $2 spread. It's not a $2 spread. It's a $2.50 spread. So 2.5 minus 0.9 is 160. Okay, I said 140, it's really 160. So we're going to take 90 divided by 1.6, gives us a really juicy return, 56%. Now, again, some of people might say, all right, well, maybe I'll back off the delta. And so you might, if you're comfortable with this number of contracts, and maybe you're just doing one, you might be okay with that. Or some might jump out here to this 195 and maybe edge on the side of a little bit higher probability with a lower return. Okay, so on this one, we can do 1,500 contracts divided by 160. We could do 9. Now, if you don't feel comfortable with 9, don't do 9. You position size to whatever your size account is. We're going to go ahead and do 9 because we can in this class. We'll do first trigger sequential. We'll put in this order to go by it back if it gets to where we've got a lot of that gain rather than trying to get every last penny out of it, right? So this time, let's go 0.9 times, let's say, what if we get 75% out? If we get 75% out, then 25% is left. And let's try that one more time, 0.9 times 0.25. So about 22 cents is where we'd want to buy this back. So we're going to plug in our 22 cents here. We're going to make this good till canceled, and we're going to send it on its way. All right, that's going to go into our short verticals bullish bucket. Now, we spent quite a bit of time at the beginning of the class kind of talking about what do you do if the trade doesn't work out in your favor? What are our options? What can we do with that? So the same is true with these. Maybe some of them, one of these examples doesn't work out. That's okay. All right, we can work with it. Possibly we may have to do that polarity change and say, okay, this thing is now bearish, but you really want to feel comfortable about that, making sure that you're like, yeah, it really has changed and you're not just a little skittish. Okay, kind of like Gilead and Low. We don't want to do it because we're a little skittish, but we're not convinced we're wrong. We could easily go in our favor. Now, if you missed a couple of weeks ago of when we ran through that scan to build the watch list, because we're going to keep using this watch list, let me show you where to find that. If you are a subscriber to our Trader Talks, which I hope that you are, rumor is there are a few of you that still have not subscribed. Oh, let me get the right. Where did it go? I'm going to say I've got a screen up here for it. And it is not going there. Let's do this. I'm just going to minimize this. And I'm going to minimize our slides here because it's in the background, okay? When you subscribe to the Trader Talks, you can see our playlists. You can see other things we're doing, like the new bite-sized content we've been talking to you about that allows you to, learn a little piece of something in a short period of time without being a big, long class. However, if you were looking for the watch list, okay, the update of the watch list, you'd want to come find the short verticals class. And I'm just going to scroll down till we see it. Barb taught for me last week, which I appreciate. And so it has her face on here. But if you go to, say, play all, it's going to list them here for you. All right. And so come back here to just this pink one. Short verticals unleashed, scanning, planning, and execution. That's where we redid the watch list. So those of you that are looking for that watch list, that's a quick and easy way for you to find that. Okay, so if you haven't subscribed, be a subscriber. Makes it so much easier to find our information. Now, I did not see a survey out here today. Okay, so you guys are off the hook for that. But if this was helpful to you, the information that we talked about, go ahead and do a thumbs up on the way out. That lets other people, makes it easier for them to find the webcast. So you're kind of doing a stranger for somebody, which is great. All right, you guys are a friendly community. All right, let me head back here. Get this a little bit prettier than where it was. All right. I'm just looking to see if there were any questions that are just kind of left a little bit in limbo here. And Brett's helping out, I think, with a couple of those questions that may have just come in. So, yeah, can you use confirm and send to see the data? Yeah, you can before you just send it on the way. Yeah, you can go ahead, load it up, look at it before you hit confirm and send on the way. Very good. Well, you guys, coming up next, Ben Watson's going to be doing our scripting studies class. He's going to cover for Mike today. Ben, as always, does some fun stuff with ThinkScript. So take a little break, get a beverage, come on back for our scripting studies webcast. Brett, thank you for your help today. And Cameron, if Cameron came back. We'll see you soon. Bye-bye.